Hi, folks. Welcome back to Finance for Humans, Finance Made Simple. I hope you have enjoyed the last video where we talked about balance sheet and P&L. And today we are talking about cash flow statement, the third main financial statement in accounting. We are also talking about accrual versus cash-based accounting, which is a concept essential for us to understand the importance of the cash flow statement and its purpose. Let's check it out. In the last video, we talked about accounting fundaments and we talked about the balance sheet. We have the liabilities and equity on the right side, where we have the origin of the economic resources of a company. And then we have on the left side the assets, which is the destination of those economic resources. And then we have the P&L, where we record and demonstrate the transactions which are done by the company with the assets to generate profit. These three areas are interacting among them. So we have liabilities and equity generating money for the company. And then this money is converted into assets. Those assets are used to generate profit. And then this is coming back again to our equity. All right? We discussed that on last video. But all of these three are interacting basically with one very important element, which is cash. So cash is reported under the assets area of the balance sheet. But everything a company does ends up in cash. All those three areas, they have a relationship with cash. The cash flow statement is demonstrating this interaction. Cash is not only money in our pockets, right? Cash could be like bank deposits, financial investments, which are convertible into cash in 90 days. Example number one, a company is established, okay? If you have seen our first video, you will see that we are using the same examples. We are using here periods. You see here P0 and P1. This P0 is, let's say, when the company has nothing yet. And P1 is when the company starts having something, investments from the investors, buying goods or whatever. So let's call as well the P's, the periods, 30 days, just for our exercise here. So in this case, my cash from P0 to P1 increased 50. We will demonstrate in our cash flow how this 50 ended up there. We have our cash flow. The format of the cash flow I'm showing you here is not exactly demonstrated this way. I'm using just a format to show you how the cash flow works. In the future videos, I'll be showing balance sheets, P&Ls, and cash flow as they should be demonstrated according to the accounting standards, right? Here is just our exercise for didactic purpose. So basically here we have our initial cash, which is 0. And then we have our investors investing money in the company. And then we have our suppliers selling us in payment terms, in 60 days payment terms, let's say this way, okay? This is generating assets without having a cash disbursement. Therefore, I show here as an origin of resources. Every time I have an increase in my liabilities and equity, I have an increase in cash because I have an origin of economic resources for a company. I have my initial cash and I sum these two concepts in our cash flow demonstration. On the other hand, I have my assets. My assets are investments the company does with the money coming from third parties or investors. Let's use this example, the facilities. We bought facilities at the cost of 50. So this is demonstrated in the cash flow as a reduction of cash. I bought 50 in goods, and this is also impacting my cash flow in the amount of 50. Every time I have an increase in my assets, I have a decrease in cash because I'm using the company's money to buy assets. So I'm decreasing my cash position. Therefore, when I get my initial cash, sum it up with equity suppliers, and I deduct the facilities and goods investments, I have my final cash of 50. This is how a cash flow works. Let's have another example. Now let's use the same example as before, but we are starting from period 1. And now the company is already operative with revenues paid in cash. So our customers are receiving the goods, they are paying it in cash. Now our cash position is moving from 50 to 150. How does it work in our cash flow now? I have my initial cash position of 50 of P1. Now my profit is generating an origin of resources, and therefore my equity is increasing in 50. This 50 is now shown in my cash flow as an increase in equity. Then I have my goods being sacrificed because I have used that to sell to my customer. I don't have them anymore. And we have discussed before that whenever we have an increase of assets, I have a decrease on my cash position. The opposite is also true. So when I have a decrease in my assets, I have an increase on my cash position. Therefore, we will be demonstrating it here as an increase of cash of 50. And then my final cash is now 150. Simple like that, okay? Let's have another example. Now the company operates with the same result, but instead of having the customer paying the company 100% upfront at the receipt of the goods, the customer is paying 50% cash and 50% in 60 days terms. My cash, which was initially 150, is now 100. I have an accounts receivable now, which is a right for me to receive this money in a later stage from my customer. My accounts receivable, I reported it in my cash flow as a reduction of cash of 50 because I'm increasing my asset. And therefore, my final cash is now 100. One element is calling our attention here. Our profit is no longer in our cash. Therefore, what we can conclude from that is that profit is not always cash. Why? The accrual-based accounting is when revenues and expenses are recorded when a transaction occurs, even if payments are not received or disbursed. On the other hand, on a cash-based accounting, my revenues and expenses, they are recorded when cash is received or disbursed. Which are the pros and cons of these two methods? So basically, cash is simpler. You don't need a bunch of people, very robust ERP to record your transactions or anything. So you basically need your bank statement to see what you have paid and what you have received and record it at the time it was done, okay? It's much simpler. Also, to track cash is simpler because everything which is happening in my cash is demonstrated at the same time I have paid or received in my financial statements. On the other hand, we will see it later on for measuring a company's financial health, and as a managerial support, this is not good because we see a very limited range of transactions recorded in our books. Who are then the users of one and another? So basically, all companies can use accrual-based accounting. There are some which must have it done in the accrual-based accounting, which are the publicly traded companies and the medium big companies. Sometimes they need to be audited because they need to report those financial statements to banks to get loans. The accrual-based accounting is required by the auditing firms as it is the accepted one by the accounting standards. Small businesses and sole proprietor, this word for me is hard to tell, sole proprietorships businesses, they can use cash-based accounting. I put it in yellow here, if you see, because I don't recommend that. The owners of the business, the managers, the CEOs, or whatever, even for small companies, they need to analyze the company's transaction to take decisions. So the accrual-based accounting is much more appropriate for that rather than cash-based accounting, okay? It can be used, but it's not recommended. Now, let's see an example to illustrate what we are talking here. Let's take two main transactions of a company, buying goods and selling goods. Let's say that in the period 0, the company is buying goods costing 50, paid in 60 days to our supplier after delivery of the goods. Then in 30 days, the company receives the goods. 30 days more, the company sells its goods to the customer, and the customer will pay for that the price of 100 in 60 days. 30 days more, I pay my supplier because it has passed 60 days from my delivery. And then after 30 days, I receive the money from my customer. In an accrual basis accounting, all of these transactions would have been recorded in my financial statements. It's a wider range of records and transactions. While in a cash basis accounting, I would have records only from period 3 and period 4. On a management perspective, for me, in an accrual basis accounting, I have much more information registered in my financial statements rather than using cash accounting, right? This is the concept. Now, let's use another example. Let's see for the same transactions, but one reported under accrual accounting and another one reported under cash accounting. Let's say that the company sells its goods now to the customer by the price of 100, who will pay the company 100% in 30 days terms. Let's see how it works. In the accrual basis accounting, this is how our financial statements would look like, our balance sheet and our P&L. In a cash basis accounting, this is how our financial statements would look like. Let's take piece by piece for you to see the difference. First of all, our cash position is the same, okay? So it's money in our pockets. In our accounts receivable, there is a change because in my accrual basis accounting, I register my revenue when I have earned that. When I deliver my goods to my customer, I have earned the right to receive the money from the customer. And then I need to report it in our financial statements. I have this right now reported under my accounts receivable, while in the cash accounting, I have 0 in both periods. Then we have our goods reported in accrual basis accounting. My initial goods were 50, and when I sold that, of course, I have 0 in my balance sheet because I sacrificed the goods to sell to the customer. But then look my cash basis accounting. I have 0 in period 1 and also in period 2. Why? Because as I haven't paid yet my supplier, I cannot register it in my assets. And also my supplier in the accrual basis accounting balance sheet, I have 50/50 because in both periods I still have to pay the supplier, while in the cash basis accounting I have 0 in my equity. As I have not reported P&L in the cash basis accounting, you can see here that we have 0. I don't have any profit reported here. Both transactions, my revenues and the cost of my goods, I have not received or paid yet. So I have 0 here. Therefore, my equity is not changing. While in the accrual basis accounting, I have my profit reported because I have earned the rights to receive the money from my customer, and I have assumed an obligation already with my supplier to pay him, and I have used the assets for that. All right? So this is how this accrual and cash-based accounting work. Of course, we recommend always using accrual-based accounting for managerial purposes and for other purposes as well. It's more complete, isn't it? So we can see much more in an accrual-based accounting rather than in a cash accounting method. I hope I could have made it simple, which is the purpose of this channel. I invite you to subscribe. Please give me your like. Your comments will be very welcome. Thank you so much and see you in the next video. Bye-bye.